South Africa's finance minister has raised income taxes for the first time in 20 years. He's also cut the economic growth forecast for 2015. We've got details and analysis on South Africa's budget in the next half hour and plenty more. Mr. Nene had a very narrow balancing act. We'll have the details on that live from Johannesburg, but that's not the only thing in the pipeline. The Gambia has launched an ambitious plan to boost rice production and end the reliance on imports. And court battles over signal distribution are threatening South Africa's digital migration process ahead of a global deadline in mid-June. We'll get around to the business of media a little later in the hour, but let's start with budget, specifically South Africa's. It has unveiled a $140 billion budget over the next 3 years. The country's finance minister has warned that it will be a tough couple of years ahead for Africa's most advanced economy. Mr. Nene announced tax hikes and extra levies in fuel and electricity, as well as higher duties on expensive property. Now, South Africans will bear the brunt of extra costs as the government looks to implement a plan to cut spending and at the same time make reforms to the way the economy works in order to boost growth. The Treasury's growth forecast for the economy this year has been set at just 2%. Sumitra Naidu has the details from Cape Town.
It's a lofty budget with the biggest chunk going to education once again. The health sector also got a big slice of the pie. Despite steady increases in electricity tariffs over the past 5 years, there will be an additional hike in the electricity levy to help Eskom keep the lights on.
The first proposal is a temporary increase in the electricity levy from 3.5 cents per kilowatt hour to 5.5 cents per kilowatt hour to assist in demand management. This additional 2 cents per kilowatt hour will be withdrawn when the electricity shortage is over.
That may be a long time coming, and the minister failed to elaborate on plans to sell off non-strategic state assets to help fund Eskom's pressing financial needs. The plan to raise $2.3 billion for the utility will go ahead, but the minister did announce higher taxes, mainly on the rich.
Personal tax rates will be raised by only 1 percentage point for all taxpayers earning more than 181,900 rands a year. This raises tax by about 21 rands a month for a taxpayer below the age of 65 with an annual income of 200 rands. What's 21 rands before fiscal drag? Listen to the progressivity of it. Let's now listen to the progressivity, because this category is not in this house.
The finance minister tried to deliver a people's budget, but he was forced to make some tough choices in order to reduce debt and lift revenues. Debt to GDP currently stands at 45%. Apart from personal income, road, fuel and electricity taxes were all hiked. And no surprise that sin taxes will also be going up. Smokers will contribute $60 million, while drinkers will add a further $120 million to the fiscus. There was some good news for small businesses: lower taxes and new incentives to help spur growth in the sector and to increase employment. The Small Business Ministry will get $350 million, and the Department of Environmental Affairs will use its extra funding to create over 300,000 work opportunities.
10.2 billion rands has been allocated over the MTF period to manufacturing development incentives and support for growing service industries, such as business process outsourcing. Under Minister Davis's oversight, the Manufacturing Competitive Enhancement Program will spend 5.4 billion rands and will assist close to 1,450 companies with financial support to upgrade facilities and skills development.
The road will remain bumpy for some time. South Africa is still underperforming. 2015 growth has been lowered from previous forecasts down to just 2%. Sumitra Naidu, CCTV, Cape Town.
Let's expand this conversation and get you some more analysis on the budget presented today. Rob Price is a market strategist at ETM Analytics, is live in Johannesburg right now. Mr. Price, let's start with your broad impressions of the budget. Mr. Nene was between a rock and a hard place. How do you think he juggled matters?
Thanks, Rama. Thanks for having me. I think let's start with the positives. There's unfortunately not too many of those. I think he he did play a good balancing act. Probably appeased the ratings agencies quite well, maybe delayed a credit rating downgrade for quite some time. We've seen quite a good revision to the deficit projections going forward, which is, as I said, encouraging. Looks like the finances are a little bit more stable from that aspect. So that is encouraging. I think the other encouraging aspect is that a number of investors were thinking that conditions could have been worse, that the government could have implemented more taxes. So those are two positives. Unfortunately, I still have to see the budget in quite a negative light. The government is trying to plug holes with increasing taxes, and that's not really good for economic growth. That's really a concerning aspect going forward. There's clearly quite a constrained tax base in South Africa already, and it's difficult to see how the budget supports growth going forward.
Indeed, the minister also did call for moderation in demands for wage hikes. Now, given the strikes and the general attitude around that industrial action that we saw last year, how is this message likely to be received by unions?
Well, I don't think it'll be received by unions very well at all. Unions are, looking for double-digit wage increases, maybe slightly just below double-digit. But I mean, the finance minister Nene spoke about a 6% increase. So it's difficult to see how these two, relate to each other. There's going to be some conflict on that point. It's important to consider that what we've seen over the last year is actually public sector wage increases have been below inflation, and in fact that's persisted for the longest period on record as far as I can see it. So I don't see how the unions are going to respond very well to this. The other aspect that's important to consider is that Nene is speaking about an increase in the actual wage bill. So even if the unions were to accept the 6.6% that he's talking about, that would imply a headcount freeze, and government's the biggest employer in South Africa on a sectoral basis, so that's quite concerning for the employment outlook going forward.
Indeed. What do you expect this combination of tax hikes, tax cuts, at least for SMEs, high levies on fuel and electricity, what impact in general do you expect that will have on the equity markets?
Well, it's difficult to draw specific impacts of each little tax on the equity market per se, but I think on a broader context, we have to kind of look at what's going on in South Africa, and it's more of the same. We're still seeing a big government that's taking a lot of money from the private sector, which makes it difficult for the private sector to conduct business. That doesn't mean there's not opportunities in this environment. There's certain equities that will perform particularly well, but equities that are just domestically focused do come under pressure if they can't find specific opportunities. One interesting aspect to consider is the fuel levy, and this massive increase in the fuel levy is definitely going to have a negative impact on the consumer. They were expecting that they would get quite a bit of inflation relief, and now that's going to be taken away by the government. So that's going to have a negative impact on retail sectors. But the other aspects we've got to look at the broader economy more generally.
One final question for you, Rob. Do we now have a clearer picture on exactly what assets the state will be disposing in order to finance Eskom's financing needs?
Well, that's a very interesting question, and we don't have a clearer picture on that at all. In fact, Finance Minister Nene was particularly coy on this matter. He did speak about it, but he spoke about the sale of non-key non-strategic assets going forward with no particular detail, and we investors will be watching out to see how government is going to organize this process going forward, and it's quite concerning that we're not seeing those details. I think that we need to see what government's going to be selling off, and in fact it's an important aspect for growth going forward. We actually need to see government selling off key strategic assets in order to create growth, things like Eskom, so that the private sector can come in and maybe do the job a little bit better than it's currently being done.
Indeed. Rob Price, market strategist, TTM Analytics, live in Johannesburg, South Africa there. Thank you. Let's move on to the Gambia. Economic growth in that country is closely linked to how the agricultural sector in the West African nation does perform. Now, erratic rainfall over the last couple of years has forced this tiny state to remain dependent on imports for pretty much everything, including its staple food, rice. It spends $50 million a year importing rice all the way from Thailand and India. Now, the government, of course, hopes to end that dependency on imports in just a year, thanks to an ambitious 2016 blueprint. Jen Kyo visited the volunteer farmers at the heart of this project. She filed this report.
In Pachar, Gambia's Central River region, women hard at work. They are transplanting rice seedlings. For most of them, it's something they've done for years. But this is different.
Everybody's gone out to the fields. We are all gone back to the land to cultivate this rice. So everybody has 2 or 3 plots cultivating in.
More than 1,000 hectares Pachar rice fields are on a pilot project to make the area serve as the country's main food basket. It's a community thing. That's why the women drawn from not just the surrounding villages volunteer their services.
I'm a good citizen. If the president begins a project, we support, even if I'm not paid. In the end, it will help me.
By doing this, we can now access the plows and fertilizers even for our own farms, and our input has increased.
Well, for decades, Gambia has been importing rice from Asia. But through this ambitious project, President Jammeh is encouraging Gambians to grow what they eat and eat what they grow. This, he says, will make the country self-sufficient by 2016.
Many of us are not talking of 2016. We are talking of the end of this 2015, because already the mechanism put in place and then the activities that are being conducted during the course of this season is too huge that we expect that we are going to meet that targeted goal.
For a country whose agricultural production has been on a downward spiral due to heavy reliance on the rains, which have increasingly become erratic, some critics have described the project as an illusion. They say the country has to do more, beginning with change of policies and investing in model farms. Each year, Gambia spends $50 million in importing 175,000 tons, or 70% of its rice, from Thailand and India. Those driving the Vision 2016 agenda, however, say those changes are being implemented.
So rain-fed fields was what we were having. And then rain is only 3 months. So now we said, wow, before we go for rain, only waiting for the rainy season to have only one crop production per year, it's better we go for the dry season production. And that dry season, we have the rivers, fresh water from the river, and the river is close to the fields. So that is why we embark on this thing, making canals, inviting water from the river to come to the fields, have what we call tidal irrigation. When the river is full, it pumps into the fields, and then it goes to the fields, to the rice fields. Everybody cultivate your rice, both dry and rainy season.
Last October, they got the first harvest. However, officials will not reveal the number of tons of the Gambianka, or Gambian rice variety, were produced. They only say the peak was in the thousands. With 2016 only months away, the jury is still out as to whether Gambia's rice revolution will be a success. Jin Kyo, CCTV, Banjul, Gambia.
Once, of course, we have data on that, it's worth comparing it to what the Nigerians are doing. Something similar. Quick run through the markets here for you, though. Positive numbers coming through in some of the markets that we track, except, however, for South Africa in the wake of the budget. We'll explain why that happened a little later on. But right now, quick run through some of the markets from the Kenyan market. Some results coming through. Kenya's CFC Stanbic releasing its full-year numbers. 6% rise in full-year pre-tax profits to about $84 million. The dividend payout, however, is up to 5 shillings 20 cents a share, and that's more or less double what they had in 2013. Up next, the Egyptian authorities are looking to the US for its wheat import demand. And we'll be in the business of media. Court battles over signal distribution are threatening South Africa's move to digital migration. Well, that and more is coming up next.
This is the first year that Africa will have more foreign direct investment than aid. And it's like the tipping point in terms of changing the way the continent is perceived. And I think this summit very much responds to that call. Now, whether it can materialize what is being announced is something that we'll have to check and see whether it happens.
Welcome back to the program. You're still watching Global Business Africa from the Kenyan capital, Nairobi. Egypt has agreed to buy American wheat in a tender for the first time in 5 months, but that only happened after traders cut wheat prices. The country had initially rejected last week's prices. Egypt, of course, is the world's top importer of the grain. The state-run buyer, the General Authority for Supply Commodities, or GASC, bought 290,000 metric tons of U.S. hard red wheat at an average price of $273 a ton. It cancelled an American-only tender last week, however, citing high prices, and instead bought cheaper European grain the following day. But the U.S. lowered its prices on Wednesday, and Egypt responded. The North African state is seeking to use a $100 million credit line from the U.S. to buy American grain. American wheat has been unattractive, shall we say, in international markets this season amid a strengthening dollar and more expensive freight costs to North Africa compared to European suppliers. Speaking of the US, a tire company based over there has been fined more than $1 million for giving bribes amounting to $130,000 to various Kenyan government departments for tenders. The US Securities and Exchange Commission charged Goodyear Tire and Rubber Company with violating the Foreign Corrupt Practices Act when its subsidiary in Kenya, Trendsetters, paid bribes in order to land tire sales. According to the SEC's order, Goodyear failed to prevent or detect over $3.2 million worth of bribes in a 4-year period between 2007 and 2011 due to inadequate FCPA compliance controls at its subsidiaries in sub-Saharan Africa. Goodyear is also accused of having paid bribes in Angola as well. Now let's get the latest details here from Daniel Rangers, who's live in Washington with more details on this particular story. Daniel, as part of this settlement, Goodyear neither admitted nor denied liability when it paid these fines, but should we expect any convictions of its American managers?
Well, the SEC generally looks at the practices that the US company was involved in to detect any wrongdoing, and also with its accounting practices. So then once it's done that, it's had that investigation. It also works sometimes a little bit with the Department of Justice, which also has jurisdiction for criminal matters. So with a criminal charge, you have to prove that an American was involved in actual wrongdoing. So maybe knew about the corrupt practices and did nothing about it, or was directly involved in handing over money. That's a much higher burden of proof. And the SEC, in its enforcement action, has made it pretty clear that it believes most of the wrongdoing, if not all of the wrongdoing, was done by the local subsidiary itself, and that the wrongdoing on the part of Goodyear was more in the fact that it had very lax compliance practices.
Given the fact that this company's $3.2 million outlay in bribes delivered $14 million, 14.1 to be precise, in profits, I mean, the math is compelling, but is merely demanding that companies forfeit these profits a big enough deterrent against such behavior in future?
Well, the deterrent works in the other way as well, in the sense that Goodyear had some calls to their hotline that's meant to detect this kind of practice, and they reported it to the SEC and the Department of Justice without those US government bodies knowing anything about these corrupt practices that emerged. And then once an investigation began, Goodyear provided them with lots of documentation and lots of cooperation. So that provides, by not fining them beyond the profit, that provides an incentive for companies to come forward and report such things. If there had been anything like Goodyear not telling them about certain other corrupt practices, for example, that happen in other subsidiaries, then that would be a different matter. And there would be more of a strong argument on the SEC's part for enforcing punitive fines. But one thing I would add is that the Department of Justice has not said that it has deferred any prosecution. So there is the possibility that some action could be taken down the line.
Right, we'll have to leave it there for the time being. That's Daniel Rangers live in Washington, D.C. Now, let's turn our attention, if you will, to our business, media. Let's start with a special focus on Africa's digital migration process in the continent's most advanced economy, South Africa. That country may once again miss the deadline for the migration of its broadcast signals from the analog to the digital scheme. Now, policy amendments, government's indecisiveness over the sort of signal that should be used, and court battles over whether controlled access should be used for set-top boxes, all of these have combined to delay the process. Here's Sumita Naidu with a look at the implications of missing the June global migration deadline on What's Hot tonight.
Back in 2006, the International Telecommunications Union announced that all countries in Africa, Europe and the Middle East would have to migrate from analog to digital by 2015. While most countries have made the switch over, it seems South Africa will miss the June deadline.
The biggest implication for missing the deadline is that the ITU, which is the International Telecommunications Union, will no longer protect South Africa, or countries who have committed to that deadline, will no longer protect the analog signals from signal interference.
Moving over to digital means more spectrum, allowing for more services in broadcasting and telecommunications. Despite the economic benefits that can be realized, South Africa is still struggling to make headway in finalizing the switch.
There's what they call the digital dividend. Because digital TV is so much more efficient in using spectrum than analog, we'll free up huge chunks of frequency, which can then be used to roll out broadband.
The encryption on set-top boxes is causing much debate between public and private broadcasters. Africa's biggest paid TV service, MultiChoice, who has invested heavily in infrastructure on the continent, says this should not apply to public broadcast services as it creates unfair competition.
The other argument that MultiChoice has put forward is that this will allow free-to-air operators who have ambitions of starting and operating pay TV services in the future to use a conditional access system that has been implemented essentially by government without having to invest in the technology.
But ENCA, which started as a free-to-air service, disagrees.
ETV's view and point to be that, well, yes, granted, we are a free-to-air service provider. However, we still need to be protected in that current environment, as having a conditional access system will allow us to negotiate better channel supply agreements.
Economists say the digital migration could have created thousands of jobs in South Africa. According to research, if the digital dividend is licensed to mobile operators, it could lift GDP in sub-Saharan Africa by $49 billion over the next 5 years. If South Africa manages to meet the deadline this year, millions of South Africans won't be able to access television services. And that's because the set-top boxes are yet to be manufactured. Now, the set-top boxes are needed to convert the signal from analog to digital. Signal distributor Centec is also battling with aging infrastructure and may need to be upgraded, but it would be at the taxpayer's cost in order to make the switch. Sumita Naidu, CCTV, Johannesburg.
Fascinating developments across Africa as well. We'll be focusing on Kenya later on in the week. Right now, though, quick run through commodity prices. Some interesting developments out of Nigeria. The Senate committee over there, the Finance Committee in Nigeria Senate, is proposing to cut the oil benchmark price down to $52 a barrel from its current figure of about 65. Now, keep in mind, gross government revenues, of course, did fall to just about $2 billion in January. Is some sense, pragmatism perhaps coming through in Nigeria? We'll find out in the course of the week. In the next couple of minutes, we'll be telling you why financing constraints are stunting the growth of small and medium-sized enterprises in Ethiopia. Well then, welcome back to the programme. Let's take you to Ethiopia, where small and medium-sized enterprises are more likely to be credit constrained compared to their counterparts elsewhere in the world. That's according to a report released today by the World Bank and the United Kingdom's Department for International Development. That report says a lack of credit is one of the key obstacles to job creation and growth in Ethiopia. Mahia Muto reviews the effects of the situation on grassroots tonight.
The Million and Friends Cafe in downtown Addis Ababa is open for lunch and customers are streaming in for traditional Ethiopian dishes offered on the restaurant's menu. Million Misfin and 6 of his friends started the business in 2012 after taking a loan of about $1,000 from a government scheme meant to help small businesses like theirs grow. They now make about $4,000 a year and are able to employ 15 workers. Misfin says they would like to expand their restaurant even further, but are not able to access more funds.
In order to receive a meaningful loan from Addis Microfinance, you need to have a house or a car owner certificate. We are youth. Where can we get all this collateral? We hope that they will look at how faithfully we have paid previous loans and give us substantial credit so that we can renovate the restaurant and even hire more people.
Millions of Ethiopians still do not have access to loans. Majority say the process is often complicated and collateral is out of their reach.
We have a lending ceiling of $73,167. We are not authorized by the National Bank to lend more than that, but we can lend to an enterprise if they can come as a group with family collateral plus the education certificates, which are also held as collateral.
A recent study by the World Bank and the UK's Department for International Development indicates that financing constraints in Ethiopia's small and medium enterprises is a key obstacle to job creation and economic growth in the country. The study shows that only 1.9% of small firms in the country have a loan or line of credit.
It assessed the SME segment from both a demand side and a supply side perspective. From both sides, what came out very clearly is the existence of a missing middle, meaning the fact that small enterprises in Ethiopia are much more credit constrained than either micro or medium-large enterprises. Normally, small enterprises are those that are crucial for job creation and growth. They are a very productive segment of the economy, and therefore it would be important to address this bottleneck of SME finance to unleash the potential of SMEs for the economic growth of the country.
We know in our country, when you look at the micro enterprise, they do not have much problem to financial access. When you go up to the small and medium enterprise, they have problem, lack of access to finance in our country. So this study will assist us to solve that problem.
Brought to its knees by famine in the 1980s, Ethiopia has transformed over the years, becoming one of Africa's fastest growing economies. The government, however, is being encouraged to focus more on small and medium-sized enterprises, which have helped other countries develop innovative financial products and lending technologies. Mahia Mutwa, CCTV.
As far as currencies go, pretty much the same trends very much in force over the last couple of days, and Naira is still lingering well under 200 to the dollar. The South African rand weakened a bit after the release of the data from today's budget, but at the same time, remember, trade data is coming out on Friday, so that will provide some direction moving forward as well. Now, here's what we're working on for tomorrow's program. We will, of course, be still focusing on the digital migration problem. Media owners are expressing fears that capacity challenges facing the Ugandan Broadcasting Corporation, which starts to transmit this TV signal, may delay the full-scale transition. We'll have more on that later on tomorrow. And we'll also be in Zanzibar. We'll be sampling the business of spices, a traditional element of the Indian Ocean Islands economy. That's it for this edition of the program. We'll see you later on tomorrow. We'd like your feedback on what we do around here. Global Business Africa at cctv.com is the email to use. And of course, Facebook and Twitter are your ports of call. We'll see you in the next 24 hours. I'm Ramanya.